With the increase of the coronavirus having a huge effect on the markets this week, let's see how it's affecting the economic calendars with Bob Mason of FX Empire. This is the Midweek Wrap. Hello Bob, and thank you once again for joining us for the Midweek Wrap. Let's start with the major currency pairs. It's the last week of February. It's normally quiet at the end of the month. Can we expect the same this time?
It's been a relatively quiet start to the week for the majors. For the dollar, markets had to wait for consumer confidence figures out on Tuesday. Marginal uptick wasn't particularly impressive. There's been a material shift in sentiment towards monetary policy, actually. We saw PMI numbers out of the US last week reflect a contraction in the private sector and, more importantly, in the service sector. So that's raised the chances of a first half of the year rate cut by the Fed, which led to a pullback in the dollar from its recent high of last week. And as a result, while we're seeing dollar support from the risk aversion stemming from the coronavirus, the likes of the euro are not sliding back since monetary policy divergence is now favouring a move by the Fed, though that might change this week. So for the rest of the week, we've got inflation figures out of the US on Friday with personal spending. So that's going to be particularly interesting, with personal spending, see if there's been any influence from the spread of the coronavirus. And leading into that, we've got GDP numbers, second estimates. Obviously, any downward revisions for those numbers, and they expect the dollar to come under pressure. And then we've got durable goods. If there's any shift in sentiment and demand, if the manufacturing PMI numbers are anything to go by, then durable goods could weigh on the dollar as well. So dollar's under a little bit of pressure, though obviously the continued spread of coronavirus, we're not expecting a material downside. For the euro, it's also been a quiet start to the week. We've had GDP numbers out of Germany with second estimates in line with first estimate, so having a muted impact. With business confidence seeing a slight uptick, it fell short of forecast, but there was no slide. So businesses weren't materially concerned over the impact of the coronavirus in February. That might change, however, as it starts to spread across Europe. Through the remainder of the week, we've got consumer spending and GDP numbers out of France. Obviously, those will garner some interest along with employment figures out of Germany. But all in all, risk aversion is considered to be euro negative. We've got Lagarde speaking tonight, which may be interesting. Will she talk of any ECB support, or will it be back to calling on member states to provide fiscal support? So that remains to be seen. Over to the pound. There's no stats this week to price towards the pound. On Tuesday, we saw the pound bounce back to 130 levels. That was off the back of the EU members talking of a willingness to deliver an ambitious trade agreement with the UK. Obviously, that is beholden upon the UK meeting certain requirements of the EU. Britain, the UK government is delivering its starting point for trade negotiations that start next week on Thursday. So we'll get a better sense of how far apart the two sides are. And obviously, the further apart they are, the likely pressure on the pound will return as that sort of trade negotiations may drag out and put pressure on a lack of progress could well be there.
With stocks down and the market in a little bit of disarray at the moment due to the coronavirus, how's it faring for the commodity currencies? Can we see an upturn?
For the commodity currencies, we've seen them stand their ground a little bit better than they did last week. That's really because of that shift in sentiment towards the Fed monetary policy through the first half of the year. Obviously, expectations had been following Fed Chair Powell's commentary that the US economy would be resilient to the coronavirus. That now seems to be not the case, which has put the US dollar on the back for a little bit. However, I expect the commodity currencies to be under pressure. Ultimately, both the Kiwi dollar and the Aussie dollar are expected to suffer at the hands of the regional economic impact that we're going to see from the coronavirus. Through the remainder of the week, for the Aussie dollar, we've got CapEx numbers for the fourth quarter and private sector credit numbers for January to consider. Obviously, those will garner some interest ahead of the RBA interest rate decision that's next week. Last time round, the RBA was talking about a rate cut, though there was a little bit of concern over the coronavirus. I think that concern would have spiked by now. So will there be a rate cut? or they'll at least be talking about it in a more mature fashion that would likely pin back the Aussie dollar. For the Kiwi dollar, we got trade data out on Thursday morning. That's going to be quite telling. Obviously, 28% of exports were to China in December, so that could have a material impact on the New Zealand economy should we see demand from China slide. Earlier in the week, we saw retail sales figures for the fourth quarter. That came out at 0.7% growth, which was much softer than 1.7% in the third quarter. So even the Kiwi dollar is under pressure, and we can expect, the pair to be under pressure through this week, and the RBA will definitely test the bulls, as it were, early next week with stats on the heavier side as well.
And lastly, we can't not mention the coronavirus and the spread, not just in Asia now, but across Europe. But it's having a detrimental effect on not just the Chinese economy, but also the whole Asian economy. Maybe you can give us your insight.
For the Japanese currencies, we saw the yen find some support this week. The yen had struggled last week during the risk aversion, with the dollar being the market favourite along with the Swissy. The shift in sentiment towards US monetary policy has really provided some upside for the yen, however, as risk aversion continues to plague the markets. Any material rebound in the yen to 109, 108 levels, unlikely, however. Obviously, the Asian region is most at risk of an economic meltdown from the spread of the coronavirus. We've seen the Taiwanese dollar, the Chinese yuan, and all the other Asian currencies, the Sing dollar and so on, all come under significant pressure over the impact of the coronavirus and on the respective economies. So for now, the Japanese yen, under pressure. We found some support this week, though much will depend on the economic data out of the US. If we see actual data shift away from the survey numbers that were disappointing, we might see, expectations of rate cut ease. The reality is, however, the Fed's got some room to move. The BOJ doesn't. So let's see what the BOJ comes up with, in the coming weeks, and whether they'll support any further monetary policy easing. For the Chinese yuan, obviously that's been under significant pressure. There's going to be significant economic disruption to the Chinese economy beyond the first quarter, and obviously that's going to affect the yuan, regardless of government fiscal and PBOC support or not. Obviously, finally, looking at the Asian currencies, the Korean won's, been one of the worst performers. That's hardly surprising considering the number of cases in South Korea, which has spiked, and the spread is continuing and the death toll is rising. So expect the Korean won to also come under pressure through the week and in the coming weeks, and we're going to expect both government and monetary policy support to have to come in to ease pressure on the economy in their respective economies.
Well, that's it for today, Bob. Thank you so much for joining us. That was the Midweek Wrap, and we will see you again next week.